Cryptocurrency has evolved far beyond digital coins like Bitcoin, with a new wave of financial technology changing how money and investments can move and be managed. Stablecoins and tokenized securities are gaining attention from governments, financial institutions, and investors as they explore the future of digital finance. I'm now joined by Brendan Caldwell, director of Caldwell Securities Limited, to break down what this shift means and where the industry could be headed. Brendan, thank you so much for the time.
Well, it's always great to be here. This is a particularly interesting topic. Let's do it.
Now, let's start with the basics. What is a stablecoin and how is it different from a cryptocurrency like Bitcoin?
Well, traditional, if I can say that, cryptocurrencies are valuable because people have decided they're valuable. They've decided that there's a currency, there's a scarcity value. They're made at a constant rate as computers mine for them. Mining being the solving of a blockchain derived algorithm, which is about as well as I can explain it. But basically, the first entity computer to solve a particular algorithm on a periodic basis is issued a certain amount of bitcoins, and those amounts are diminishing as the years go by, so that in the not too very distant future, there will have been all the bitcoins printed that ever will be. So it is valuable because people have decided they're valuable. The advantage that they've had is there've been a way to both surreptitiously but also somewhat more easily transfer value. They also have the advantage in that they are not tied to any fiat currency, any government issued currency. So they're not tied to the US dollar, although they may be valued in US dollars. And the advantage there is that if people think that governments are going to be pumping trillions and trillions of new dollars out there, the relative scarcity value of the cryptocurrencies, whether it's Ethereum or Bitcoin or what have you, means that they should, relative to the dollar, increase in value. That's the theory.
And
Stable
Brendan,
coins are
please,
sorry, go
Brendan,
on.
continue.
Sorry, stable coins are kind of the opposite of that, in that they're actually based on fiat currency. They're based on government currency. To issue a stable coin, the issuer has to amass a certain volume, an equal volume of U.S. Treasury bills or notes that back up the currency. So, to the extent that they have $100 million of stable coins out there, at least in theory, those stable coins are actually backed by uh, government issued paper. Now, the vast majority of stable coins in circulation are actually denominated in US dollars. But hopefully, to maybe further slow down the US hegemony in financial markets, that's changing.
And who's actually using stablecoins today?
Well, it's still a fairly limited market. They are available for certain financial transactions. Uh, Certain securities firms in the institutional realm are using them. It is possible to use them for certain retail purchases. They are available for financial transactions, but it's something of the network effect hasn't yet kicked in, which was the case for Bitcoin. It was worth a few $100s a coin not all that very long ago, and now they're worth what, 60 odd thousand US dollars. So the adoption of stable coins as a currency is taking place with, I think, 95+% of the transactions, as I said earlier, being in US dollar denominated stable coin.
And that brings us to the bigger story, tokenized securities. In plain terms, what does it look like to put a stock or a bond on the blockchain?
Well, both the stablecoin and tokenized securities are really trying to cure the same root problem. And that is the financial markets are really driven by a 19th century system that is utilizing 21st century technology. So take securities, the buying and selling of stocks. Historically, you bought a stock on a Monday, you paid for it the following Monday, 5 business days later. So there was a weeks long delay between purchase and settlement. Now, with technology getting better and the diminishment of actual paper certificates, 5 days went to 3 days, went to 2 days, and now in most parts of the world is only one day. But contrast that with blockchain based transactions that happen, if not instantaneously, within minutes. So it's really still a 19th century system. So too with the transfer of money overseas. Stablecoin greatly reduces the costs, where it costs maybe $6 or something like that or 6% actually, to transfer, a couple $100, which may not seem like much, but when a $200 transfer to another country is a big deal for you, whether it's $12 or a fraction of $1, makes a huge difference. And so stablecoin makes these things much cheaper. So with stablecoin, you get the better money transactions. But with tokenized securities, you don't actually own the stock. You own a token, which, much like stablecoin is backed by fiat currencies, the tokenized security is backed by that stock. An entity has a certain number of shares of IBM or Nvidia or Microsoft or whatever. Now, there are pros and cons. The pros being is that the stock market, its legacy 19th century system, is open from 9:30 till 4 o'clock, whereas most markets for most things, including cryptocurrencies, are a 24/7 market. So whether stocks go 24/7 or 24/5 as an interim step, there's no real reason that they are only traded for, what is it, 6.5 hours a day. Now there are extended markets, so I'm overstating the case, but it's still a legacy of the 19th century system where traders were in a room shuffling bits of paper and hand signals in order to trade stock. Everything is done, not even with a keystroke. Most stock trading now is actually done by computers with computers, but that's another story.
And what would you say the appeal is for a country and the average investor?
Of Well, I think of a country. I think the genius of the Genius Act, which was the Trump administration's move to normalize stablecoin, is they've created a domestic market for U.S. notes in a world where, for varying reasons, people want to buy fewer and fewer U.S. notes, and the U.S. needs to keep the demand for notes strong. Creating a system that has internal demand, because to issue the stable coins, which will probably be the de facto way money actually gets transferred. I mean, already we've seen the shift from cash to electronic, but electronic is right now still very much intermediated by the banks and their proxies for an exorbitant fee. I think the stable coin will be, for consumers, the great disintermediation of financial institutions, which why, particularly here in Canada, the banks have been very resistant to it. Companies like Tetra Trust, which we have a big stake in, which is the only licensed custodian for cryptocurrency, has just launched a Canadian dollar stablecoin, which I think will be very critical for Canadians because, as I mentioned, the US does most of the stablecoin business. And since the biggest trading relationship that's ever existed is the Canada US one, it would be a shame if 100% of that was done in US stablecoins, because I think that would greatly impact our ability to have true financial sovereignty. So I think for consumers, it'll be very important. Financial institutions, it'll be very impactful. But for Canada, I think getting involved in what will be the next wave of financial transactions will be nationally important.
Well, Brennan, thank you so much for the time.
Thank you, Teresa.